what we try to do is put an A product, new kitchens, new baths, new flooring in a slightly older property that's nice, but just not, doesn't have all the bells and whistles of the, brand new building.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. I'm your host, Jack Krupey, and also have Zack Giarrizzo with us today again. And we're going to do an internal episode. And today we're going to talk about all things commercial real estate, just kind of look back at 2023 and maybe do a little looking forward into the state of the commercial real estate market that we're heavily invested in. So Zack, thanks for joining me again today.
Yeah, Jack, excited to be here as always. We always have plenty to talk about, especially now that we're wrapping up 2023.
Yeah, absolutely. And, I think we were just talking before we hit record about interest rates, and that's been a big topic throughout the year, both the Fed funds rate that moved up dramatically. But an interesting fact is the 5 and the 10 year, which aren't really directly impacted by the Fed. And some would say, the Fed is responding to the bond market and what the 5 and 10 year do. Others think that the Fed pushes those rates. But what's interesting, and I just pulled up a chart, both the 5 and the 10 year at the beginning of the year were just under 4%. And there was some significant drops during the Silicon Valley banking crisis. It got as low as 3.3. But as of today, both the 5 and the 10 year are at 4.11, which is really not much of a move. And for all the talk of interest rates, and there's certainly some sectors and some investors that are more proportionally impacted by it, but overall, the rates from January to now are almost the same for two of the key rates that really affect a majority of commercial real estate lending. There's a lot of noise about the bridge loan debt, but a greater majority of loans are actually tracked to the 5 or the 10 year.
Right. Yeah. No, and like you said, that really has been, I would say, the biggest story of 2023 is interest rates, what the lending environment looks like as a result, what the 10 year has been, 5 year. And like you said, it's not unchanged by any means, but it does seem like we're seeing a certain level of stabilization now to wrap up the year. Do you feel that way?
Yeah, that's definitely great news. And things move pretty quickly, because if you look at mid-October, the 10 year creeped up almost to 5. I believe it peaked at 4.98%. Mm-hmm. And at that point, it was definitely causing some stress in the market. People that were thinking of potentially selling at that time, did not want to sell sort of at the peak of interest rates. It was giving some buyers some pause on sort of how to underwrite the deal. How do they underwrite their exit assumptions in 3 to 5 or 10 years if the current rate was close to 5, which was 20% higher than it was a few months before. Fortunately, that changed pretty quickly. So between October, it was 4.95 on October 19th, and today it's 4.1. And so, less than 2 months, it dropped again by about almost 20%. And this is historically, rates are, within this range for the 5 and the 10 year. They obviously dropped a bit during the 2021 when the Fed rate was at 0. But
sure.
The 10 year was never at 0 or close to 0. I think it might have gotten in the 1% range. Okay. And like in 2020, middle of COVID, 27 basis points. But once you got into 2021, it was at 1%. So, it's went up significantly, but not the 5X or more that the 5 and the 10 year have. And if you look historically, other than that 2020 timeframe, you go back to 2019, 1.5%, 2%. So then previously in 2019, it was at 2.5. So we're getting to the point where it's only a point and a half above where it had been, historically over.
We are. No, and I think when you look at, when you're doing syndications in 2019, 2020, and you think about kind of the state of the market, having a call just like this one at the end of the year, it was a much different conversation. There really seems to be, we've had plenty of doom and gloom throughout the year, but again, it seems like we're seeing much less of that now with regards to things like interest rates, where the 10-year is going, how much further can this continue? Whereas, in previous years that we've, been doing deals, it seems like, again, stabilization is a word that keeps coming to mind for me. So what's,
Yeah. No matter what the Fed wanted to do, they didn't seem to really break the economy. There's a lot of other factors like labor shortage, that have kept unemployment low. Just it's every situation, every cycle is a bit different. I always use that term. History may not repeat itself, but it does rhyme. And the Fed's kind of using the standard playbook of raising rates, and that generally slows the economy. And I think it has, it's certainly, at least on the commercial sector. I mean, it's certainly caused a few banks to fail, caused lending to tighten in general. But overall, the good news this time around is the economy is pretty resilient. I think the inflation that we had was really from external factors. You had COVID, and you had the money printed during COVID, plus just all the pent up demand and supply chain issues that were all coming together at once. So,
right,
this was really a response to really just like a probably once in a century type of an event. Hopefully that COVID was once in a century.
I can't deal with it more than once.
Yeah.
So
exactly.
So Jack, with that in mind, just to finish up here, the term of interest rates, what we're seeing in that space. How are you seeing operators really kind of adapting to the new normal with rates where they are now compared to, like you mentioned, so many years of practically free money? How are you seeing operators adjusting? What does that mean for kind of the deals that you're looking at?
Yeah, so those that were in deals 2-3 years ago, those that got into deals with fixed rate debt are trying to figure out how to refinance long term. Some are going into some loan modifications and working with their current lender for another year or two. Others are just tracking the 5 and the 10 year and trying to time their refinance into long term debt. And those that are looking at deals now are just generally underwriting more conservatively, looking at a lower loan to value from the start, because of the higher cost of borrowing. It doesn't support the same 75% or potentially up to 80% loan to value. Most deals now are 60-65% loan to value, which is good for investors. It's just safer with less leverage. And pricing has come down from the peaks. But I just saw a stat the other day that on average, the pricing is really only down about 11%. Because the fact is, the only people selling right now are generally forced to sell because of just the way their capital stack is structured, and they can't support the higher interest rates, and they're not capitalized enough to just pay the higher rates for another few years, or life events. Two of the recent deals that we participated in were estate sales where they were just selling because someone passed away and then the family didn't want to continue to run the property. So there's always life events that cause sales. And, what we're seeing now is really the back to the basics. Deals that have positive cash flow day one, not buying opportunities where there's really no cash flow and the entire profit is just from renovating units and essentially flipping the property. It's a combination of current cash flow with that upside. Long term of appreciation and forced appreciation through value add.
Yeah, no, and like you said, this feels better for investors when you're looking at, investing in a property based on actuals, based on what's really coming in, not necessarily, having to go in and do huge renovations in a short timeline. It seems like this is better for investors when it comes to, having conservative numbers, having conservative day one cash flow rather than just hoping that you can double your money in 2 years on a quick sale like we were able to see for several years. It feels like a safer environment in that sense.
Yeah, absolutely. And it does, obviously everyone loves to make a 50, 100% return. I mean, we had deals where we doubled our money in a year and 2 days. But it also can somewhat poison the well. Investors get used to that and sort of chase higher risk, and they want that 50, 60, 70% IRR and really underestimate the level of risk that may have been taking to generate that IRR. And
Right.
it goes back to that Warren Buffett quote of when the tide goes out, you see who's swimming naked. And I think these are the deals we're doing now. The tide is out, and we're getting good deals when the tide is out, and we're swimming with our with our best bathing suits on.
That's great. Yeah, no, and I certainly agree, and it's good that we're able to be us as well as the operators that we work with are able to be really selective on deals, right? And so, can you talk a little bit about maybe over the past 12 months how deal sourcing has changed? And you mentioned estate sales, having these kinds of semi off market opportunities as a result. What are you seeing in terms of off market versus who's getting the best deals from the best brokers? It's been a tough year for brokers.
Yeah, absolutely. And look, I think part of it is the well capitalized, the deals that are going really well, the deals that locked in fixed rate debt. There's no reason to sell early. A few years ago when the market was just running up 20% a year, there was multiple offers on properties. It was pretty easy to sell. There'd be sometimes 20, 30 offers, and then there'd be 4 or 5 that went to highest and best. So, if a broker got a listing, it was pretty easy for them. They just needed to weed through it, figure out who to invest with. But, many of the deals are just not very similar to residential housing. Many of the best deals are just not, if they're not distressed or forced to sell, they're probably going to wait around and ride their low interest rates. But, you have a combination of just those life event estates, people who've owned properties a really long time, which, who have such a low basis, they can sell whenever they want. It's really just a life event thing, or tax planning. And you have the deals that have some level of distress because of the interest rate environment. Those that bought in 2020, 2021 may have overpaid a little bit, may have been undercapitalized. Those deals often don't fully come to market. There's a lot of quiet listings. There's a lot of people trying to do a combination of either sell or maybe do a recapitalization or maybe sell into a joint venture, roll some of their investors into new deals. So it's time to be a lot more creative. And I think that's where the good brokers stand out. And that's where our operators who are best in class in markets really excel as well, because they're the ones that will get that phone call because they're a guaranteed closer. Right. And it's often, there's often deals being bought where it's not even the top price. But if you're a seller and you want to get something done in 2023 and it was a month ago, you can't take the risk of someone else not either being able to rate, not having the money to close, or just not having the sophistication in the lending and the ability to pull all the pieces together. So certainty of close is very, very important. More so than ever. Perhaps 2 years ago, a seller might take a chance on a newer group that was the most aggressive in paying the highest price, and now it's much more about certainty of execution and also just the confidence that they're going to take care of the asset, because some of the sellers, especially those estates and longer term owners, they care about the property, they care about their employees. They care about their tenants. Some of them may have known their tenants for 10 or 20 years. They want to make sure that the property's in good hands.
Yeah, we've had several conversations like that with operators, over the past 6 months, especially, where, some of them may have tried to buy a particular property several years ago, got beat out by exactly like you said, one of these aggressive buyers coming in, offering a lot more money than the second highest bid. And now, there are a number who are getting kind of a second stab at some of those properties now that, they did that were overpriced at the time. And now, we are starting to see 10, 15, even 20% discounts on some of these properties from the same people who would have bought them at that price several years ago.
Yeah. In some cases, it's even a year ago. There were deals that were potentially going to sell right before the Fed started moving rates in 2022. And in some of those transactions, they just never closed. And now the sellers coming back a year later, just realizing that, if they still want to sell, the pricing is going to be a little bit different. And they're just coming back to market now. I mean, there was a lot of deals people walked from hard deposits too, because at the peak, there were people putting offers in with like $500,000 hard deposit day one prior to any diligence. So
That's
those
right.
that did that, and then interest rates moved 2 or 3% in the few months they were trying to raise capital and finalize their loan terms. A lot of them just realized their numbers didn't work when rates moved.
Yeah, no, and really operators are having to really to work with the new normal in that sense and understand that, we could have interest rates where they are for the time being, and it's not, just going to be up and down immediately. And, as we work with that, the deals will have to reflect it. Another thing that has really become the new normal that could be an issue across several states, geographies, is insurance. Jack, what are you hearing about, changes in insurance, how it's altering deals, especially some of the states that we operate in, Texas, Florida come to mind?
Insurance is significantly higher. I just saw a quote from one of the operators that we talked to, that on one of their properties, insurance went from $400 a door to $1,200 a door. So 3x increase from the prior policy. We had a deal that we were looking at earlier this year that we had raised some money for, and it was an assumption. So we had thought we were past that point, but the insurance, because of the change of ownership, was going to change, and the bank actually was requiring a higher. On the assumption, they made some requests for a higher amount, which changed the pricing. And fortunately, just because of the way the contract was structured, we're able to walk away. There was no loss of any deposit or any investor funds, but we had a deal we loved with a really low interest rate to assume that the insurance just changed the dynamic of the whole deal. Made the deal not work. It's challenging, and I don't know, don't know what the answer is. Hopefully there's maybe some more competition that comes into the market. You certainly can't. I'm certainly not a proponent of any sort of government regulation on it. I mean, you have to let the insurance companies, charge what they think makes sense. We did have a period of years where there really weren't any major hurricanes or losses, but over the last few years, there's been a few come through Florida. And, there was obviously large ones in Texas over the last decade, especially, Houston had a large one about 10 years ago. So, it's a problem. And I think it's just something else that's going to continue to price into deals. Just fortunately, I know the groups we work with are very sophisticated, have good insurance brokers that are able to shop for the best available policy, and are smart enough to price it into the bid and not underestimate it. Some of the newer, less experienced buyers may not do that, and can be a major surprise once you close on the property and you get your renewal.
Right. No, and I mean, these changes in the cost of insurance, change in interest rates, this really alters the IRR that investors have become accustomed to. And if you don't underwrite it properly, we're talking about a deal going from 20% IRR to substantially lower. And it's something where you really do have to know who you're working with and be able to underwrite a deal properly, given all the changing factors that we're dealing with on a daily basis.
Yeah, absolutely. It's it's something I've seen inexperienced operators make those mistakes. Insurance, property taxes. It's really it is the basics though. I think over a few years, when you have this incredible bull market, I think sometimes people lose track of the basics from time to time, and now we've gotten back to a new normal. And I've seen that from the early 2000 .com crash through the 2006 2008 housing crisis to now. It's it's a cycle that does seem to repeat itself.
Sure. No, and I mean, another one that is quite basic in the sense of investing in real estate that we're really adapting to is rent growth. You look at how rent growth has been, I mean, just booming for several years now, as more renters are forced to continue renting long term, moving to different markets as a result of remote work and any number of other factors. But there are markets now where we're starting to see a bit of a slowing in rent growth in markets that have been going up substantially.
Yeah. I mean, there's multiple levers here. I mean, you do have. I think we've sort of reached the peak of affordability in some markets. You had also a lot of COVID money floating around, and I think a lot of people just saved a lot of money. Between some subsidies and also just not commuting 2 hours a day, not going out to eat as much. So I think it was a time for many to actually save some money. I know my grocery bill. I guess the grocery bill went up a little bit, but the restaurant, the travel, everything went down for me as well. And so I think in some markets you're kind of reaching a peak of affordability. But I saw a stat recently. We're at about the most unaffordable to buy a house that it has been in generations. So the cost to rent, even with the higher rents, the cost to rent is about as cheap as it's ever been. It's really just coming down to sort of what's the affordability, what's the what happens to wage growth. Another stat I just saw. Toll Brothers, the CEO of Toll Brothers Home Builders, was on CNBC yesterday. Just had it on in the morning, and he said on average, 10% of the residential market was new construction. But there is such a supply shortage right now that on average, 30% of home sales are actually new construction over the last year. And that is the highest that's ever been.
Wow, interesting. Especially when we've talked on the show before about a lack of new construction in the country, about how there's been a significant need for, a lot of what we do, the Class B value add multifamily deals, because there has been a lack of new construction. It's not always affordable to build. That's a really interesting stat. I had no idea, Jack.
Yeah. And that's obviously Toll Brothers is primarily single family towards the higher end of the market. But I think what's driving that is that 70% of the population either doesn't have a mortgage or is locked below 4%. Those that are locked below 4% largely don't want to sell. You don't want to,
No.
The person who would have traded up, the person who would have sold their 2,000 square foot house and bought a 3,000 square foot house a couple of years ago and taken advantage of the appreciation now realizes it'll cost them more. Even if they're unlocking a few $100,000 in equity, let's say they literally sell the house for the same price. Sell it for 500, buy another one for 500. It's just going to cost them more money, even with a lower loan to value. So people are choosing not to sell, and there's a lack of supply. That lack of supply will continue to push more people to being renters. In certain multifamily markets, Texas in general, I mean, there is some new supply coming. However, primarily that supply is the Class A, the higher end, $2,000, $2,500 a month rents. Whereas we're largely invested in the Class B value add, which is $1,200, $1,400, $1,500 rents. So you cannot build that product right now, not without a ton of government subsidies, tax breaks, etc. It's impossible to build for that cost. Now, in some markets, if you build a really nice Class A, maybe some of the tenants will move into the Class A. Maybe it pushes the old Class A building to kind of A minus. So, it doesn't mean that the new construction doesn't have any impact, but I think largely what's being built is sort of for a separate audience. And, our workforce housing tenant base, it should largely be stable. And what we try to do is put an A product, new kitchens, new baths, new flooring in a slightly older property that's nice, but just not, doesn't have all the bells and whistles of the, brand new building.
Right. No, and like you said, that is stable. This is a group that, isn't able to purchase a home. They are still looking to rent. They are still in a lot of the major markets that, that we're investing in right now. Like you said, Texas, Florida. These are still areas where people are living, people are working. And, we are still, we're not seeing that changing anytime soon.
Yeah. And the populations are still growing.
Mm-hmm. Well, I think we've gone through quite a bit of what we're seeing in 2023. Jack, anything that you want us to look for a little bit going into 2024 now that we're working this new normal?
Yeah. I think this is going to be a big year. A lot of that distress, which we alluded to, should come to a head in 2024. Now, I don't think it's going to have a drastic impact on overall pricing. The fact is, only about 10% of the multifamily market, as an example, used bridge loan debt. It's a stat I saw recently. So there's still a lot of family offices, a lot of just investment groups that were conservative and had 5 and 10-year debt. But in the market that we play pretty heavily in, I think we're expecting to see some significant opportunities for those investors who bought in 2020, 2019, 2021 that are going to be looking to sell or refinance in 2024. So I get really excited as someone who made a majority of my wealth from the distress of 2008. I just get really excited about these opportunities that may come down the pike. And I will say, everything we've done in the last 6 to 9 months has been some of the best deals we've seen in 10 years.
Absolutely. No, I think we have a lot to look forward to in 2024. So thanks as always for having me on, Jack.
Yeah, thanks for jumping on. It's a great conversation. And to our audience, please remember to check us out if whatever platform you're on. Like us on YouTube, subscribe, Spotify, iTunes. Please, if you like what you're hearing, leave us a review and reach out to us on both Zack and I are active on LinkedIn. Zack, you're a little more active on Twitter, but we have a Twitter account, Facebook, Instagram. We have a Facebook group. So let us know if you have questions, if you have something you want us to talk about, and definitely just reach out to us. And we love to have conversations with investors. So thanks, everybody. We'll see you in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.